Schwab Asset Management has made a significant announcement. They're planning share splits of 20 of their ETFs, including the very popular Schwab US Dividend Equity ETF, also known as SCHD. These share splits are expected to happen on October 10th, right at the close of the market. And SCHD is one of the ETFs that will be affected by a 3:1 stock split, meaning for every one share, investors will soon hold 3 shares. Now you might be wondering, why is a stock split such a big deal? These days, stock splits aren't as common as they used to be, especially since a lot of people now buy fractional shares. But here's the twist. When it comes to ETFs, a share split is even more rare, especially considering all of these ETFs currently trade for less than $100 per share. In this video, we'll be taking a close look at why SCHD is going through the split, what it means for investors, the fund's portfolio, dividend yield, and whether now is the right time to buy into this popular dividend ETF. What is the SCHD stock split? Now, before we get into SCHD stock split, let's first clarify what a stock split actually means. A stock or share split is more of an administrative adjustment more than anything else. It doesn't change the overall value of the stock or ETF, but it affects the price per share and the number of shares investors hold. The value of the asset remains the same. Let's break it down with an example. Take a company, for example. Company A trades at $500 per share. Now, if you wanted to invest $250, you'd need to buy a fractional share if your brokerage allows that. With fractional shares becoming more popular, this is often the case. But not all brokerages offer this option. Now, suppose Company A has a market cap of $5 billion and at $500 per share. It has 10 million shares outstanding. If the company announces a 5:1 stock split, the price per share would drop to $100, but the number of shares would increase to 50 million. The market cap remains unchanged at $5 billion. In SCHD's case, the ETF will be undergoing a 3:1 stock split, meaning that for every one share an investor holds, they will soon have 3 shares. The share price will adjust accordingly, but the value of your investment remains the same. So why is Schwab doing this? Unlike many other platforms, Schwab doesn't offer fractional trading for ETFs. This stock split will make it easier for investors, especially those who can't or prefer not to buy fractional shares, to get involved with SCHD. More accessible prices mean that a wider range of investors can participate in this popular dividend-focused ETF. Understanding SCHD's portfolio. Now that we've covered the stock split and have an understanding about it, let's now get into SCHD's portfolio and why it's a solid choice, especially for investors with tech-heavy portfolios. SCHD serves as a great complement to portfolios that are heavily focused on technology stocks. One of its key strengths lies in its sector diversification, which balances out the concentration in tech that many investors might have. Technology stocks only make up 10% of SCHD's holdings, making it well diversified across multiple sectors. When looking at strong bull markets, they're often driven by a variety of sectors rather than just one or two. This is exactly why SCHD has performed so well over the years, and it's not overly reliant on any single sector, allowing it to thrive in diverse market conditions. Presently, SCHD is trading at $84 per share. This means after the upcoming 3:1 stock split, that price will be closer to $28 per share, making it more accessible to a wider range of investors. As of now, SCHD manages assets totaling $60 billion, and over the past 12 months, it has seen impressive growth, climbing 19%. Dividend yield and growth. One of the most attractive features of SCHD is its strong dividend yield and growth. Currently, SCHD boasts a 3.4% dividend yield, providing investors with consistent income. But what makes it even more impressive is its remarkable 12% dividend growth rate over the past 5 years. SCHD has also built an impressive track record of increasing its dividends for 12 consecutive years. This ongoing streak shows the reliability of SCHD as a long-term investment. In fact, The latest dividend payout saw a substantial 15% increase compared to the same period last year. Unlike individual stocks, valuing an ETF like SCHD involves looking at the broader portfolio of companies it holds. SCHD is made up of 103 different positions, with the top 10 holdings accounting for more than 40% of the fund's overall composition. This gives investors exposure to both stable dividend payers and potential growth. SCHD's top 10 holdings. SCHD's portfolio is packed with high-quality companies, and its top 10 holdings alone account for more than 40% of the entire ETF. Let's break down a few of these major players and see how they stack up against their historical valuations. Number 1. Home Depot, or HD. The first holding to start with is Home Depot. A leading name in the home improvement industry is expected to generate an EPS of 15.73 cents next year, giving it a forward PE ratio of 25.3x. This is higher than its 5-year average of 22.7x, suggesting that the stock is currently overvalued. However, with the expectation of lower interest rates ahead, Home Depot could see some benefits. Number 2. Verizon Communications, or VZ. Next, we have Verizon, the telecommunications giant. Analysts project an EPS of $4.72 for the coming year. This results in a forward PE of 9.5x, which is roughly in line with its historical averages. This indicates that Verizon is fairly valued at its current levels. Number 3. BlackRock, or BLK. The next holding is the BlackRock, is one of the biggest financial firms globally, expected to generate an EPS of $46.68, translating to a forward PE of 20.1x. This is just slightly below its 5-year average of 21x, reflecting that the stock is slightly undervalued. With the current easing of monetary policies, BlackRock is well positioned to continue performing strongly. Number 4. Bristol Myers Squibb, or BMY. Bristol Myers Squibb, a key player in the healthcare sector, is expected to generate an EPS of $6.98 next year. This gives it a forward PE of just 7.2x, which is well below its 5-year average of 9.1x. Based on this metric, the stock is undervalued. Although BMY has faced challenges recently, a strategic acquisition could potentially boost its growth in the near future as it works to develop its pipeline. Number 5. Texas Instruments, or TXN. Texas Instruments, a leader in the semiconductor industry, is expected to generate an EPS of $6.27 next year. This translates to a forward PE of 32.1x, significantly higher than its historical average of 23.8x. Despite this high valuation, analysts predict strong growth for TXN and its competitors over the next few years. However, given the recent surge in semiconductor stocks, a pullback might be on the horizon. Number 6. Lockheed Martin, or LMT. Next, we have Lockheed Martin, the defense giant, is projected to generate an EPS of $28.45 next year, resulting in a forward PE of 20.4x. This is above its 5-year average of 16.6x, indicating the stock is overvalued at the moment. Despite this, Lockheed remains a high-quality stock, particularly in the defense sector, which has seen global demand. The company's strong backlog of contracts stretches well into the future, making it one to watch closely. Number 7. Amgen, or AMGN. The next holding is Amgen, a major player in the biotech industry, is expected to generate an EPS of $20.58 next year, giving it a forward PE of 15.4x. This is slightly above its 5-year average of 14.7x, suggesting that the stock could be overvalued at the moment. Nevertheless, Amgen remains a significant force in healthcare with its broad portfolio of therapies. Number 8. Chevron, or CVX. Chevron, one of the largest energy companies, is expected to generate an EPS of $12.51 next year, giving it a forward PE of 11.2x. This is below its 5-year average of 13.8x, indicating that the stock is undervalued at present. Recent pressure from lower crude oil prices has affected Chevron stock. But depending on global factors such as elections, this energy giant could see significant upside in the future. Number 9. Pfizer, or PFE. For Pfizer, analysts expect an EPS of $2.80 next year, equating to a forward PE of 10.1x. This is well below the company's 5-year average of 13.9x, making it undervalued based on this metric. While Pfizer has struggled lately and needs to rejuvenate its drug pipeline, its current valuation presents potential for growth if it can find momentum. Number 10. Cisco Systems, or CSEO. The last holding on our list today is Cisco Systems. It's forecasted to generate an EPS of $3.56 next year, resulting in a forward PE of 14.7x, which is right in line with its 5-year average. Cisco continues to position itself as a strong player in the tech world, especially with its focus on capitalizing on the growth of artificial intelligence, or AI. Yes, we can use the content to serve as the conclusion by summarizing the key points while reiterating the strengths of SCHD as a long-term investment. To structure it as a conclusion, we should emphasize the ETF's balanced sector diversification, dividend growth, and its potential for wealth accumulation over time. Conclusion. As we come to the end of this video, SCHD stands out as a compelling option for long-term investors, despite some of its top holdings currently being overvalued. Its diversified portfolio across multiple sectors ensures resilience in varying market conditions, while its emphasis on companies with strong dividend growth histories provides steady income potential. With a dividend yield of 3.4% and a proven record of consistent dividend increases, SCHD offers both income and growth opportunities. For investors looking for a balance of high yield and stability, SCHD's mix of robust companies like Pfizer, Chevron, and Cisco offers a unique blend of security and potential upside. As a result, SCHD remains an attractive ETF for those aiming to build long-term wealth through compound growth. For those thinking about what their next steps should be, SCHD could be worth considering ahead of the upcoming share split. But what's your perspective? Are you loading up on SCHD right now? Share your thoughts in the comment section. If you enjoyed and gained value from this video, please hit that like button, subscribe for more insights, and I'll see you in the next video.